Have you ever seen a snowball roll down a hill and get bigger with every turn? At first, it's small, but as it rolls, it picks up more snow, gets bigger, and gains speed. That's exactly how dividend snowballs work. You start small, reinvest your dividends, and over time, your money grows exponentially. In this video, I'll show you and John exactly how the dividend snowball effect works. I'll also show you the ideal portfolio that combines the perfect stocks and funds to make your dividend snowball work for you. I'll show you 3 strategies, one with a one-time $10,000 investment, one with a monthly $100 investment that would match it, and the last with a daily $10 investment strategy that would 3 times the return. At the end of the video, I'll show you how these strategies can turn into $1 million portfolio, one that pays you anywhere from $5,000 to $15,000 every single month in dividend income. But first, how does the dividend snowball effect work? Well, it's exactly like what it sounds. Your money starting small but steadily building momentum over time. It's like rolling a tiny snowball down a hill. At first it's small, but as it rolls, it picks up more snow, growing bigger and bigger. This is what happens with your investments when you reinvest the dividends that you earn. The more dividends you get, the more shares you can buy, which then pay you even more dividends. It's a cycle that builds on itself, and that's how your dividend snowball grows. At its core, the dividend snowball effect is driven by compounding. Here's the idea. Let's say you start with $1,000 and decide to invest it into a stock priced at $10 per share. That gives you 100 shares. Now, if this stock pays a 4% annual dividend, you'd earn $40 in dividends in the first year, just for holding the stock. Now here's the important part. Instead of spending that $40, you instead reinvest it to buy more shares. Since the stock price is still $10, you buy 4 extra shares, giving you 104 shares at the start of year 2. In year 2, those 104 shares now earn dividends as well. This time, it's $41.60 instead of $40. Reinvest that, and you buy 4 more shares, bringing your total to 108 shares. In year 3, those 108 shares earn you $43.20 in dividends. Reinvest again, and you now own 112 shares. And just like that, your portfolio keeps growing, not because you added more money, but because your dividends are working for you. Each year, you're getting more dividends, which buy more shares, which then pay you even more dividends. That is the snowball. It starts small, just a few dollars more each year, but the longer you let it roll, the faster it grows. After 10, 20, or 30 years, the difference in each year's payment can increase by 40 to 60%. Okay, so now that we've got the basics down, let's break down 3 simple strategies I've used and that you can follow too to grow your dividend snowball over 30 years. 1 involves making a one-time investment. 1 involves investing $100 every month. And 1 is all about a consistent, daily $10 contribution over time. All 3 are incredibly effective, it just depends on your situation and what works best for you. To keep things clear and practical, I'm going to use a real-world example. Kroger Company, ticker symbol KR. It's a well-known grocery chain with a strong history of paying and growing dividends. It may not be flashy, but it's consistent, which is exactly what you want when building long-term income. It pays a 1.96% dividend, and that payout grows about 12.58% a year. Plus, the stock itself has averaged 6.45% growth annually, so you're getting both steady income and long-term growth. So let me walk you through what happens when I use Kroger for these 3 strategies. 1 where I invest $10,000 up front, 1 where I invest $100 every month, and 1 where I invest a little bit regularly, like every day. Let's see how the numbers play out. Let's start with the simpler option, a one-time investment. If you have $10,000 to invest today, instead of letting it sit in a savings account earning practically nothing, you decide instead to invest it all in Kroger Company and let it grow for the next 30 years. No extra money added, no daily stock checking, just let it sit and do its thing for the next 30 years. After the first year, your $10,000 would grow to $10,841. With reinvesting dividends after 10 years, your investment would double, reaching $23,779. In 20 years, it'll be valued at around $68,494, and by the 30-year mark, your investment will snowball into a solid $276,708. Thanks to all those reinvested dividends over the years, your portfolio will be paying you $25,925 a year, or about $2,160 every month. Okay, so let's take a look at what happens when you go with our second strategy, which is a $100 a month investment. Basically the cost of a few dinners out or some unused subscriptions. In the first year, it's simple. You've invested $1,200. After 10 years, that small habit builds up to $18,493. Not bad for something you barely noticed doing. Push through to year 20 and you're now looking at $73,922. The snowball is picking up speed. By year 30, the investment will grow into a portfolio worth $323,905, paying around $30,234 in annual dividends, or about $2,520 per month. But what would the results be if you used the third strategy, like putting in $10 a day, which is about $70 a week? Let's break down what that could look like. $70 a week over 30 years. Right, so maybe you don't have $10,000 lying around to invest all at once. Totally normal. But if you can set aside $10 a day, you're already in the game. This approach is all about being consistent, small, steady steps that grow over time. In your first year, you will have put in $3,640. Modest start, but we're setting the stage for future growth. After 10 years, your portfolio would grow to about $56,094. After 20 years, you're now looking at $224,229, and by the 30-year mark, your portfolio will be worth a solid $982,511. As for the dividend income, after 30 years, your portfolio would be paying you about $91,711 in dividends. That's roughly $7,643 per month. So I know what you're asking. Which approach is better? What's going to work for me? Dropping a lump sum all at once or slowly building it up month by month or week by week? Honestly, all three strategies work. And all three rely on the same magic, reinvesting dividends and giving your money time to grow. The one-time investment is great if you've got cash ready to go. It is a set it and forget it kind of deal. On the other hand, the monthly or weekly investing strategy is perfect if you're starting small but want to stay consistent. It's like building your snowball one scoop at a time, and while it starts off slow, it picks up serious momentum the longer you stick with it. Alright, so now that you see how these strategies can work, the next big question is, where should you actually invest your money? Well, good news, I've put together a solid list of stocks and funds from different sectors that check all the right boxes: safe, growth-ready, and built to deliver strong returns. By the end of this video, you'll see how this mix can help you earn around $5,000 to $15,000 a month in passive income, all from a single, well-balanced portfolio. Here's the key: you want a portfolio that's diversified. That means spreading your money across different types of investments, not putting all your eggs in one basket. This helps keep things stable, lowers risk, and gives your dividend snowball plenty of room to grow over the long run. Let's walk through some of the best types of investments you can include in a strong dividend-focused portfolio. First up, you've got high-yield dividend stocks. These are companies that pay out a larger chunk of their profits as dividends, which means they give you more income up front. They're great if you're looking to earn a steady cash flow sooner rather than later, especially if your focus is more on income than on big stock price growth. A good example here is the Altria Group with the ticker symbol MO. It's got a dividend yield of 7.08%, which is pretty high, and it's been paying and growing those dividends for years. In fact, its 10-year dividend growth rate is 7.18%. The share price doesn't grow much, about 1.1% per year, but with that kind of dividend payout, it more than makes up for it. Next, there are dividend growth stocks. These don't necessarily pay the biggest dividends right now, but they steadily increase their payouts over time. That means your income goes up year after year, which is perfect for long-term growth. AbbVie, with the ticker symbol ABBV, is a standout here. Its current yield is 3.12%, but what's more impressive is its 10-year dividend growth rate of 13.65%. On top of that, the stock itself has been growing at around 12.05% per year, so not only do you get a growing income, but your overall investment is increasing in value too. For extra diversification, it's smart to include real estate investment trusts, or REITs. These invest in real estate properties and tend to pay out higher dividends, which helps boost your income. REITs can also behave differently than regular stocks, which is helpful during times when the market gets a little shaky. Prologis, ticker symbol PLD, is a great REIT to consider. It offers a 3.73% dividend yield, a 10-year dividend growth rate of 11.16%, and its stock has been appreciating at about 8.65% annually. That makes it a strong pick if you're looking for both income and long-term stability, especially with some real estate exposure in your portfolio. Now, if you want a simpler way to get into dividend investing without picking individual stocks, dividend ETFs are a solid option. These funds hold a mix of dividend-paying companies across different sectors, helping to spread out your risk. One of the best in the investing world is the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. It's got a 3.58% dividend yield, a 10-year dividend growth rate of 11.04%, and a stock appreciation rate of about 7.62% per year. So with SCHD, you get broad exposure to reliable dividend-paying companies with less hassle. Lastly, it's smart to have some consumer staples in the mix as well. These are companies that sell everyday essentials, things people keep buying no matter what's going on with the economy. Because of that, they tend to be more stable in rough markets. Target, with the ticker symbol TGT, is a solid pick here. It has a 4.31% dividend yield and a 10-year dividend growth rate of 8.4%. Its stock has grown at about 2.51% per year, and it's got a reliable history of paying out dividends consistently. Adding a company like Target can help balance your portfolio and keep it steady when markets get shaky. With this combination of high-yield dividend stocks, dividend growth stocks, REITs, ETFs, and consumer staples, I'm building a portfolio that's designed to be both stable and reliable. Each piece plays a different role. Some give me solid income right away, others steadily grow that income over time, and together, they all help my portfolio stay balanced even when the market gets rocky. What ties it all together is diversification. By spreading my investments across different sectors and types of assets, I reduce my risk and give my money more ways to grow. And over time, this approach helps my dividend income rise year after year, all while keeping things simple and stress-free. So next, you need to calculate your portfolio dividend yield, dividend growth, and its price appreciation. It's actually pretty straightforward. To get the average dividend yield, take the dividend yield of each stock or fund in the portfolio, add them together, and then divide by the total number of holdings. In our case, I used 5 investments: Altria Group at 7.08%, AbbVie at 3.12%, Prologis at 3.73%, SCHD at 3.58%, and Target at 4.31%. When you add all those up, you get a total of 21.82%. Divide that by 5, and you get an average dividend yield of 4.36%. I used the same method to calculate the average dividend growth rate and the average annual share price appreciation. By averaging the 10-year dividend growth rates and the historical share price increases across these 5 investments, I came up with a dividend growth rate of 10.29% and an annual share price appreciation of 6.39%. So when I combine all these stocks and funds into one portfolio, it gives me an average dividend yield of 4.36%, a 10-year dividend growth rate of 10.29%, and a share price appreciation of 6.39% per year. And now that we've put together what I believe is a solid dividend portfolio, it's time to look at what kind of returns we can realistically expect from it. So back to our 3 strategies. Let's say John starts with a one-time investment of $10,000 and lets it sit for 30 years. He's not adding anything extra along the way, he's just letting it grow on its own through the power of compounding and reinvested dividends. After the first year, that $10,000 grows to around $11,075. Fast forward to year 10, and the portfolio will nearly triple to $29,966. At the 20-year mark, it'll reach $111,373, and by year 30, the original $10,000 will snowball into a $562,921 valued portfolio. By the end of those 30 years, this portfolio would be paying out around $62,284 a year in dividends. That's about $5,190 every month. Over 30 years, the portfolio could grow by $552,921, with $205,958 coming from stock growth and $346,963 from reinvested dividends. Okay, so if you don't have $10,000 to invest up front, as we've established, no worries. You can still reach the same goal by using a $100 a month strategy. Let's break it down. After the first year, you've put in exactly $1,200. Fast forward 10 years and your portfolio will grow to $20,971. In 20 years, it'll be valued at $101,688, and by year 30, you're sitting on $542,500. After 30 years, this portfolio would be paying you $59,891 per year, which breaks down to about $4,991 every single month in passive dividend income. Out of all that growth, $185,991 came from stock price gains, but the real hero, reinvested dividends, they alone added $320,509 to your total. All that from just $100 a month. Now let's talk about the third strategy. Instead of investing a lump sum up front or $100 monthly, you instead decide to put in $10 every day, which comes to $70 per week, into this portfolio. It's simple, steady, and works great if you want to build wealth gradually with smaller, regular contributions. After the first year, you will have invested $3,640, which sets the stage for future growth. By year 10, your portfolio would be worth around $63,611. At 20 years, you can really start to smell the compounding. It climbs to $308,453, and by the 30-year mark, you would be sitting on an impressive $1,645,583. The income from this, huge. After 30 years, your portfolio would be paying you about $181,671 a year, which is roughly $15,139 every single month. Of the total growth, $564,172 comes from stock appreciation, while a massive $972,211 comes from reinvested dividends. Altogether, that's $1,536,383 in value added. Would you like to know how just $20 a week could grow into a portfolio that pays you over $6,000 a month in dividend income? Click the video on the screen.